And you can see from the first chart we'll look at, we have the XLE, which is the energy ETF, the energy spider, and the crude oil prices. Now, let's take crude oil prices first. Crude oil prices have basically gone up, what, 85% since the low in February of 09. And we have a series of higher lows and higher highs pretty much into October of 09. And at which point the price went to about $85 a barrel from under 50. So it doubled in price. Well, 80% in price. It went sideways after that. So let's draw some, let's look at this in terms of how I look at it technically. Okay, here's the uptrend. Higher high, higher low, higher high, higher low, higher high. Right? And that was a multi-month uptrend. Then the way I look at it is we had a sideways consolidation area, or a consolidation period in crude oil prices. And that was very important because crude oil was able to digest the prior gains. Went sideways between 85 and 70. And in February turned up again for what I consider to be a new up leg after the digestion process in this multi-month area right here. So now we have a new uptrend in crude oil prices, which to me means that as long as crude oil consolidates between, let's say, $87 and $82, the next likely move up in crude oil is going to be up. Where can it go? I think crude oil can go to 91st, and then 100 could be a magnet. Now it could go to 91st just in a general technical continuation of the uptrend. 100 to 100 plus, I think, would require a geopolitical heightening of tensions to levels we have not seen. That is almost dangerous for the world community. So that's the crude oil situation, and it sets the tone or the underlying expectation for the energy sector itself. Now let's go up to the ETF. The ETF too has a series of higher highs and higher lows in an uptrend. And to use the same sort of channel analysis, let's draw the channel lines on the XLE. And that's, so you see the uptrend lasted until here, went sideways. Well, let's call this the sideways action. Okay, so the sideways action between October and February, and it's still in its sideways channel, but it's about to break out. It looks like it will break out. And where is that breakout point? Well, we closed at 59 and change. The breakout point is, let's call it 60-50, 60-80. And if that happens, we can expect the XLE to take off. Now, where can it take off to? Well, if it decides to, if the XLE is going to the top of its channel, which has been a very well-defined channel, and the integrity of the channel remains totally intact, then it's conceivable that the XLE is headed to as high as $68, $69 from where we are now, 59 to 60. That's a substantial percentage up move. In fact, what is that percentage up move? 69, let's call it, divided by 60 is 15%. So that is a very good reason to keep the XLE on our radar screen, and perhaps even to take positions in the XLE sooner rather than later. But what about the underlying components of the XLE? Before we go to that, first let me switch out here. Let me put the overall S&P 500 index in there, and you can see that whereas the XLE is still attempting to break above its prior high, the S&P already did it. In fact, the S&P's prior high was what, 1145, 1148, and the S&P now is at 1194. So 1194 divided by, let's call it 1150. 1194 divided by 1150 is, it's almost 4% above its prior high, whereas the XLE has yet to break above its prior high. All right, so there's the other chart. All right, so let's go to the components now of the XLE. All right, first we'll do the integrateds. Let's first do ExxonMobil. Now ExxonMobil looks very different than the XLE, doesn't it? The XLE is pretty much over here, trying to break out, or on the verge of an upside breakout of its prior high. Now, by the way, the moving averages I have are the 20, 50, and 200-day exponential moving averages. And let's go back to these charts. I just want to show you the moving averages, just because they're important. Look at the moving averages of the XLE. They've turned up, and we bounced off of the 20-day exponential last week. All right, that's important. What about crude oil? Crude oil, all the averages are pointed up. Maybe we'll come down and test the 20-day exponential. I don't know. However, this is all support in here. So it's a very healthy technical action in and around the moving averages. Okay, so let's go back to ExxonMobil. And let's put the volume data in ExxonMobil too, because the volume data on these individual charts is important. If I can find, oh, there it is. Okay. All right, now, so this is ExxonMobil, right? Now, it looks very different than the XLE. We've already talked about that. In fact, if anything, let's call it an attempted base pattern in Exxon Oil. Now, this is the February low, where all the indices and all the lots of individual issues made their lows. So, for now, ExxonMobil is in a minor uptrend off of the February low, but it is lagging badly. The overall index, the XLE index. So let's call this a weak component, a weak or relatively weak component of the XLE. Interesting though that the ExxonMobil is now approaching its 200-day MA. Now remember, the XLE and crude oil are both well above their 200-day exponential moving averages. But one thing we should keep in mind is that ExxonMobil, you have the 20-day that just crossed above the 50-day. That's a very important near-term technical sign that the turn, that Exxon is in the turn. What does Exxon have to do? It certainly has to get above the top of its channel. Number one, let me redraw this channel to make it more accurate. And so right here, 69, 69 and a quarter, you get a close above that in Exxon, and Exxon should be off to the races. Where can it go? I think that Exxon can go considerably higher into the gap area left behind on the way down in December. And where is that gap area? Anywhere between 71.5 and 72.80 is where ExxonMobil should be heading. All right. Now let's go to another one of the integrateds. Let's go to Chevron. Now this is a completely different picture than ExxonMobil, is it not? Much more bullish, much more constructive, much more powerful chart. It is now climbing towards its prior rally peak after a pullback. Now it doesn't look like crude oil. It doesn't look like ExxonMobil. It has its own particular profile. The moving averages, you see the moving averages here. The 20 is above the 50, which is above the 200 exponentials. 20 and 50 have turned up, and now the 200 is turned up as well. What do we look at when we look at this chart? Let's look at the channel.